Are we good?
We are live. Thank you for coming to our presentation. Jaden, take it away.
All right. Hello. We are the morning class of the spring 2023 Low-Income Taxpayer Clinic at Lewis and Clark. I'm Jaden Burke.
I'm Bo Fennessy.
And I'm Ryan Mepp.
And our presentation today is going to be about life planning for young professionals, mostly college graduate types. We're going to be talking about planning both to pay back your past debts, mainly student loans, and we're also going to be talking about planning for the future by saving for retirement, talking about 401ks and retirement accounts. So we're going to start with Bo, who is going to discuss retirement accounts generally.
We can get the next slide. All right, so the tax benefits and benefits in general of contributing to a 401k is what I'll be talking about today. The 401k gets its name from section 401k of the tax code. We can, the next slide, please, Sarah. All right, so a 401k is obviously a retirement savings plan. You probably heard it in commercials from your employer. It's a pretty common type of retirement account. It is only offered by employees or employers in the United States. It is an employer-sponsored account. That means you can only establish a 401k or contribute to a 401k if you are employed in the U.S. It's different than a Roth IRA for a lot of reasons we can get into later. And one of the things that recent college graduates should remember is that you don't necessarily need a fancy job to be enrolled or to establish a 401k. I was working at a grocery store chain and not making a lot of money, and I was still offered the opportunity to establish a 401k and contribute to it as well. Bring to the next slide, please. So one of the biggest benefits of a 401k is the potential for employer matching. It's up to the discretion of the employer for the percentage of your income that is matched. Each employer will be different. Typically, it ranges from about like 3 to 5% of your income that they'll match. Like I said, each employer does it differently, so it's really important to talk to HR at your employer to find out how to maximize the benefits and maximize your contributions with your employer. So the biggest benefit by far of a 401k is it's not taxed and it's deducted from your gross income. And when I say it's not taxed, I mean it's not taxed when you contribute to it. So it will be taxed when you eventually withdraw from the account when you retire. But when you contribute to it, it's not taxed and it's deducted from your gross income. So the more you contribute, the less taxes you could potentially pay currently. So that is a big benefit of it. The idea is that when you withdraw in retirement, you'll be in a lower tax bracket, theoretically be more financially stable. And so when you do take that tax penalty, you'll be in a better place and it'll be less of a penalty when you are retired. Even if you change jobs, the money you contribute to your 401k and its earnings belong to you, regardless of if you started the fund at one employer and then moved to a different employer, those funds do belong to you. Some employers do have some requirements of you having to stay at that job for a certain amount of time before you're able to take the money that they've contributed with you to a different job. The money you've contributed on your own is yours no matter what, no matter how long you're at a job or not. The money your employer contributes, that can be up to some different requirements of when that money is fully yours or not. I think the next slide, please. So there's a limit to how much you can contribute to a 401k every year. In 2023, that number is around 22,000. That is with you contributing and your employer contributing as well. So it cannot go past that, regardless of how you split it up. If your employer contributes nothing, that limit stays the same. Same with an IRA, you must be 59.5 to withdraw without penalties. And the penalty for early withdrawal is usually 10% on top of any other income tax that you would owe with it when you withdraw, because it will be considered income. And generally, the sooner you open a 401k and start contributing to it, the better, just because the money will have more of a chance to make money, and that money will be reinvested in the account, and so your money can compound. The longer you do that, the more money you will theoretically have to reinvest, and then the more money that money will make, and so on and so forth. You do have some say typically in what the money will be invested in, but it will likely be from a list of approved options from your employer. It's typically a list of mutual funds, bonds, securities, typically low risk funds. Some employers might give you a list of different funds to choose from. Others might say that this is the fund, and you just have to do with that what you will. But again, talk to HR at your employer to find out what's best for you. Slide, please.
And this is where I come in. So specifically talking about a traditional IRA, getting into some more of the details that Bo touched on. The difference between the traditional IRA and the 401k is that this is the private side of your saving, right? So this is not through your employer. And as the name suggests, this is a retirement account, an individual retirement account. For those early careerists that we're speaking to out there, this is relevant because now we're going to have jobs. We're graduating, we're going out into the workforce, and we're going to have great jobs that allow us to save for retirement. And this account, much like the 401k, allows for tax deferred benefits. But a general rule that you should always keep in mind is that there's no such thing as a free lunch when it comes to the IRS. There's almost always going to be a catch. And so I'm going to get into some of the ways to plan to avoid some of those consequences best you can. But I think it's important to distinguish between a Roth and a traditional IRA. Today, I'm going to be focusing mostly on a traditional IRA. But the Roth is another type of IRA account that basically has the opposite type of benefits than the traditional IRA. So as we mentioned, the traditional IRA allows you to set aside pre-tax dollars, and you don't have to pay income tax on that money or those earnings until you withdraw it. The Roth is the exact opposite in that you pay income tax up front, and then you are putting post-tax dollars into that account, but that's the last time you have to pay tax on that money. So if you put that money into a Roth IRA, you've already paid taxes, and as it grows, when you withdraw, you don't have to report that as income. Next slide, please. But as I mentioned, we're focusing today primarily on the traditional IRA. And at some point, you may be considering withdrawing money from the IRA. And so there are some pretty strict rules about these accounts that you want to be aware of. There are exceptions that you can navigate in a listed number of circumstances, and some that are particularly relevant for the early careerists are things like buying your first home, paying for educational expenses, and the potential birth or adoption of a child. So I'll touch on some of those exceptions moving forward. Next slide. So the IRAs generally, Bo touched on a few of these, but they are designed and intended for withdrawals to happen once you turn 59 and a half. The withdrawals are limited. You must report that amount as income, as I mentioned, in the year of withdrawal in the traditional IRA. And generally, if you don't meet these criteria, not only do you have to report that withdrawal as income, but as Bo mentioned, you have a 10% penalty on top of that regular income tax. And so that's an important distinction, is that not only are you going to pay your typical marginal tax rate, but also an additional 10% on top of that. Next slide, please. So exceptions to the early withdrawal penalty. So we're just talking about that 10% that I just mentioned. Excuse me. So for current educational expenses, you can withdraw and apply that money to qualified higher education expenses for both, or for all you, your spouse, your child, or your grandchild. So that might be relevant for you. It might be relevant for your parents or your grandparents. Unlike many of the other exceptions, the educational expense exception has no limit to the penalty exception. So generally, you'll see that these withdrawals are going to be limited in their amount because the IRS wants to limit the amount of benefit that they're giving you in avoiding that 10% penalty. But educational expenses are one of the few instances where there is no limit to the amount that you can apply. But an important reminder is that you still must report that as income. So you're still going to be paying income tax on that withdrawal. This is just a way to avoid that additional 10% penalty. As it relates to the birth and adoption of a child, one limitation, it must be within 1 year of birth or legal adoption. So the IRS is, very much limiting to a specific demographic, right, within the first year of that child's birth. And the child must be less than 18. So that applies obviously to the adoption side of this exception. And it's limited to $5,000, right? So anything that you contribute over $5,000 to these types of expenses will again be subject to that 10% penalty. So it's only that first $5,000 that will be exempt from that 10% penalty. And then finally, probably the most prominent exemption is the first-time home buyer. So this actually, despite its name, applies to more than just the first-time home buyer. The statute specifies that as long as you have not had an ownership interest in a primary residence for the preceding 2 years leading up to the withdrawal, then you qualify as a first-time home buyer. Again, there's a limit of up to $10,000 of avoidance of that penalty. So they're really trying to allow for the exception to contribute to a down payment. And we, again, want to reiterate that you still must report this as income. The exception to the 10% is not an exception to your income tax. And a case study that came up through our clinic was a situation where a person had withdrawn and used it as a first-time home buyer down payment for a house, seeking that exemption. But as easily imaginable, when you set aside that money initially, it doesn't always occur to you that down the road when you use it, you might have to report it as income. So the client failed to report it as income in the subsequent year, so we had to work with the IRS to remedy that situation, and further facts came to light requiring analysis of whether the 2-year period for the exemption even applied given complex community property laws. So there are a lot of situations where you need to be careful about the planning, as we started this presentation with, and make sure that you are aware of exactly how and when and how much you can qualify for as a way to avoid this 10% penalty. Next slide.
All right, so up until this point, my colleagues have spent the time talking about retirement accounts and sort of the tax consequences of putting in money to a 401k or to an IRA, and then the tax consequences of withdrawing that money. But for a lot of recent college grads, the most important thing to them, just right out of getting out of college, is how am I going to pay back my student loans? That's sort of their most pressing concern. And then after that, once they get that sort of situated and they know how much money they're going to be able to save at the end of every month after paying for their student loans and all their other expenses, then they can start planning for retirement. So I'm going to talk about that first piece, which is how are you going to pay back your student loans? So the three kind of the two topics related to that are income-driven plans and just the normal paying the full amount of your debt plans. And then at the end, I'll just go in and talk about a couple of related issues that have to do with education credits, but are maybe not that relevant to people who have graduated college and are not planning on going back anytime soon. Starting with debt relief, this is going to be relevant to people who are on an income-driven plan, which might result in loan being either forgiven or discharged. And there's a fairly key distinction between those two things that are fairly important. And then I'll also take some time to talk about debt relief generally. And then I will talk about deductibility of interest for people who are paying their student loans the normal way. And then I will talk about interest deductions generally. And then, like I said, I'll go into at the end and talk about some education credits. So generally, the IRS treats debt forgiveness, barring certain exceptions, as a form of income. The justification for this is that if you take out a loan for, say, $100,000, and then the debt is discharged or you're forgiven, then you now have $100,000 that you're now not expected to take back. So that's basically as if you had earned $100,000. And so they're going to tax you on that in the year the debt is discharged or forgiven. The two main exceptions to this are if a person is insolvent or in bankruptcy at the time the debt is discharged. But those two exceptions don't really come up in the student loan context, which is why thinking about this is especially important in that context. Next slide, please. So any failure to pay student loans in full will result in potential tax liability due to discharge of indebtedness income. What this means is that if you enroll in a student loan repayment plan that is not going to pay off the full amount of your debt, and you're not otherwise protected based on some exception, then you're going to have to pay income on that debt discharge. So just understand that even if you're enrolled in like a plan that says this is how much you're going to pay every month, don't assume that the debt is just kind of fades away at the end. That debt is still there and it's still potentially lurking and can upset things in your future. Like I said, student loans are not dischargeable in bankruptcy. Are they usually not? It depends on the circuits. The circuits just agree on this. Some circuits are more harsh on this. But generally, they're not going to discharge your debt in bankruptcy. Student loans are also generally not dischargeable due to financial hardship. So you're not going to get them discharged just because you're insolvent. Next slide, please. So there are a couple of exceptions to this that are not going to be considered, they're not really considered debt discharge, or they're not considered debt discharge for IRS purposes. In general, if the government decides to forgive student debt, either through this sort of durational period where they're allowed to just forgive student debt, or by that's between December 31st, 2020 and January 1st, 2026, or any act of Congress or a sort of executive that specifies in the bill or the executive order that this is debt forgiveness and there will be no tax penalties. They can always do that. The government's always allowed to forgive student debt without the tax consequences to that. And so that would be relevant if something like the Biden plan goes through regarding student debt. And so that's a form that is exempt from being considered income. Also exempt from being considered income is the student loans that are forgiven under a student loan forgiveness, public service student loan forgiveness program, which is where you work in the public interest for a period of 10 years, and then at the end, and you pay based on your income, and then at the end, the debt is forgiven. And so, for people who are considering going into the public interest, this is a very noticeable benefit, both because you pay off your debt faster than under a traditional income-driven plan, and because you get to avoid the tax penalties at the end. So just understand that there are going to be filing requirements for this sort of thing, and that you're going to want to comply with those, because that's a very big financial boon to you if you're going into the public interest sector. Next slide, please. Any other form of student debt discharge is probably going to be income. So if you participate, like I said, in an income-driven plan and you do not qualify for the student loan forgiveness, you're going to have to consider the tax consequences to that. From what I found in just kind of my brief research, of the roughly 6 million or so college graduates who are currently enrolled in an income-driven plan, about half of them qualify for the public service loan forgiveness, and about half don't. So for the roughly 2 to 3 million people who are enrolled in income-driven repayment plans, but who are not qualifying for student loan forgiveness, they're going to have a potentially large tax burden. The tax balloon payment is what it's referred to at the end of the 20-year period of their income-driven plan, which is, if you're thinking about it, if you graduate college at, 22 to maybe 25, then you're thinking 20 years in the future, and there's just going to be this big payment, potentially equal to the amount of your debt times your marginal tax rate. So, and it can push you into higher brackets for a year. So you can end up paying, 30% of the tax on whatever debt that you have outstanding. So if you have $60,000 of student loan debt that gets forgiven, or it gets charged, I should say, then you could be paying 30% of that in a single year, and just have to deal with that. And that can very much disrupt your life at that point. You have kids, or you're looking to buy a home, or you're paying a mortgage, or you're planning for retirement, and this big payment at the end of a 20-year period could be a really big obstacle that you have to plan around. And that's ultimately the main kind of takeaway from our presentation. I'll go into this a little bit more, but ultimately the main thing is that proper planning is extremely important when you're talking about these long-term kind of like retirement plans, or paying off a big debt like a student loan debt. Next slide, please. So on the other side of the student loan issue is that the people who are just paying their debt off normally. So when you're paying off your student loan debt, you're going to be paying off some amount of principal and some amount of interest. It's the same as any other loan that you might have. And under the tax code, interest payments are generally deductible. So if you're paying a mortgage, for example, the interest payments on that mortgage are going to be tax deductible. However, different forms of interest are going to be treated differently under the tax code, and student loan interest payments are maybe treated more differently than most. and they have their own code. It's section 221 of the income code. Next slide, please. The important consideration when it comes to student loan interest payments is that it's an above the line deduction, when typically interest payments are below the line deductions, unless they're for business expenses. But typically when people think of interest deductions, they're thinking of home mortgage deductions. And the main sort of benefit this gives you is that you can still take the standard deduction. You don't have to itemize, you get the standard deduction, and you get your student loan interest deduction on top of that. And this is the lesser amount of $2,500 or the amount that you actually pay. Can you please get that off of my screen? So this benefit is going to be phased out for taxpayers earning more than $70,000 annually, and it's roughly doubled for a married couple. And if you are married filing separately, you're just eligible to do this at all. So that's going to be the same thing when we start talking about the education credits. Is that there are a couple of requirements. There's the income requirement that's usually pretty steep. Things get phased out very quickly for both the income deductions and the education credits. And for both the education credits and the interest payment deductions, if you are married, you have to file jointly. If you file separately, you're just going to be made ineligible for a lot of things. Next slide, please. So those were the two kind of main considerations for people. You just graduated college. You're probably not going to go back to school. You're starting to plan for your future. For people who are currently in college or who are looking to maybe return to get a graduate degree or something, there are two credits that are available. The first one is generally not as applicable to people who are about to graduate or looking to return to college, because the American Opportunity Tax Credit, you have to be pursuing a degree at least half time in university. And you must not have completed 4 years of higher education already. So that's going to be that's kind of a deal breaker for most people that are probably going to be the target audience of this presentation. That's not really, this credit's not going to be relevant to them. But because I'm going to talk about the other education credit, I'm just going to talk about this one briefly. It is a credit, which is generally better than a deduction. It's $2,500, and it's partially refundable, but it's going to be gradually reduced for more than I'm sorry, I can't see my slide, but I think it's $80,000 annually. Can I move this? That's good. Yeah, it's going to be gradually reduced for taxpayers earning more than $80,000, but it's phased out completely at, I think, $90,000. Once again, roughly double that if you're married filing jointly, and you don't get a dollar if you're married filing separately. Next slide, please. The more relevant credit for people who are for recent college graduates is the lifetime learning credit. This is a much more generous credit in terms of its requirements. You can be pursuing a degree or credential, or just taking courses at a university or a trade school to improve job skills. So you don't necessarily have to be pursuing a degree or even a certificate. You can just be wanting to. It is a lifetime learning credit, so it's more about just kind of general improvement. We do have to be enrolled in at least a single academic period, so 1 quarter, semester, or trimester. Not a particularly onerous requirement. It also has the same income phase outs and general requirements and ineligibilities. But it is, rather than being a flat $2,500 credit annually for the 4 years with the American Opportunity Credit, the lifetime learning credit is 20% of the first $10,000 spent on education in a tax period, so a single year. And then so it's basically a max payment of $2,000, or if you paid less than $10,000 in a given year, 20% of whatever you paid. This is non-refundable. So rather than the American Opportunity Credit, which is partially refundable, this is a non-refundable credit. So it's just going to offset income that you owe. And like I said, subject to requirements. Next slide, please. So the main kind of key takeaway from our presentation from all three of the topics that we presented on is that planning is something that you have to do. You have to do starting very early on. You can't just kind of expect to sort out all the things you're going to do in your life as they come to you. You need to have a plan for how you're going to pay off your student loans. If you want to get into the public interest, do that as soon as you can. Comply with requirements. If you want to pay off your student loans the normal way, make sure you know that you can deduct the interest and it's above the line. If you're not doing either of those, then you're going to have understand that you're going to have a good payment at the end of a 20-year period, and then you have to plan around that. If you're planning for retirement, you want to start doing that as soon as you get steady employment. Next slide, please. And so this brings us to our conclusions, and I will let Bo begin here.
Yeah, so just in conclusion, contributing to a 401k can be very beneficial, especially as we've been saying, if you start early, let that money compound. Another thing I should mention is that when you have the opportunity for employer matching, it's not a either or situation. It's a use it or lose it situation. If your employer is offering to match 5% of your income in contributions, if you don't contribute, it's not as if that 5% gets added to your paycheck instead. That money just disappears and isn't used, doesn't go anywhere. So definitely in your best interest to use that matching contribution, take advantage of it if you're able to. Otherwise, the money is just lost.
And for my key takeaway, all the exceptions and the nuance that we talked about, the most important thing is to remember that as far as the traditional IRA is concerned, you still must report that as income. It's pretty easy to forget because this may happen years down the road, but it's very important that even if you plan accordingly and execute a way to avoid that additional 10% penalty, you still must report that withdrawal as income and pay the income tax accordingly.
And then understanding the tax consequences of student loan repayment is an important part of the repayment process. It's not enough just to say, how can I get a job that I can earn enough income to pay off my student loans. You're also, it's not just, the question's not just how am I going to pay off my student loans, it's how will I do it? What process do I want to go through, and what are the tax consequences of that process? And that's going to be an important financial consideration because it can save you a lot of money in the long run if you know what you're doing and you plan ahead.
Thank you so much. We do have one question from the audience. The question is, when someone becomes eligible to withdraw from a 401k, is there any limit on the amount that the person can withdraw at a single time? And is that answer different for an IRA? I think, Ryan, your topic kind of best overlaps with that question. Do you want to take it?
Yeah, sure. And Bo, feel free to add anything. But from my understanding, so the 401k and the IRA are very similar. The Roth, there's a little bit of a distinction. Like we talked about earlier, the tax implications are different in that account, whereas the traditional IRA and the 401k are very similar. As far as limits to withdrawal, once you hit that 59.5 point, that age, you can withdraw as much as you want. There's no limit there, but that kind of goes back to my initial point of like the IRS wouldn't be doing it unless they were benefiting from it, right? There's no such thing as a free lunch. So typically at that point in time, the weightiest consideration is going to be tax avoidance. So remember, from those accounts, when you withdraw, if you withdraw 100% of it, you're going to be paying income tax. on 100% of that value. And again, generally, as you're preparing for retirement, you're probably reducing your income and you're trying to limit your tax liability. And so that's kind of the catch there, where it may sound great that, oh, I can withdraw all this money. But in reality, people in that situation generally will not want to, because that will be the time when they have to start paying taxes, especially on those earnings that they've been accruing for all that time. And this is further kind of supported by the IRS's rule on the backside, which is that once you reach the age of 72, they require minimum distributions, which they refer to as RMDs. And that's because so many people in that situation want to defer taxes. Generally, the rule that taxpayers abide by is put off taxes as long as I possibly can. And so people will not want to withdraw money from those accounts because they have accrued so much and continue to accrue more tax-free dollars. And so that is generally the situation people find themselves in, to the point that the IRS had to make an additional rule that once you turn 72, you are required to withdraw a certain amount of that account. I don't know the dollar number off the top of my head, but they require you to withdraw that so that they can get their taxes, right? That's where they're getting their piece, is that they're going to require you to withdraw that and pay income tax, so that those accounts don't become a vehicle where the wealthy, ultra wealthy can pass tax-free dollars to their heirs without being subject to income tax. So important considerations and good question. Thank you.
Yeah, just to piggyback off that, while you are able to, withdraw 100% of the account as soon as you reach 59.5, like Ryan said, I don't think it would be in your financial best interest to do so. These accounts can become very large over time, and it would kind of just go against the principle of, again, like what Ryan said, setting up these accounts to limit your tax penalty the best you can. And especially with 401k, the idea that you'll be in a lower tax bracket when you start withdrawing, as one of the key benefits, you're kind of just disregarding that if you would withdraw 100% of it, or a large percent of it as soon as you're able to. So just things to keep in mind.
Thanks so much. We will be having another presentation today at 1:30. So we hope to see all of you there as well. Bye-bye, everyone.
Thank you.